Okay, welcome back. This is Open Exchange, and we're coming to you live from the CNBC-TV18 Motilal Oswal studios. Hemang Jani is still with us. We're also, of course, upon market open. We'll take stock of the stock market and, of course, the rupee markets as well, which, of course, have swung so wildly. The bias on the rupee, of course, has been on the depreciation side. So Nifty starts 20 points lower, in line with what the SGX was indicative of. But this is just a start, and things will pick up. The rupee also the dollar rupee rate should also come up on your screens. We didn't quite get to 83. We are now at 82.59, 82.58 as compared to yesterday's close of 82.49. So it's a bit of a depreciation, which is coming through about 9 or 10 paisa or so this morning for the currency. So 82.58 on the dollar rupee. Hemang Jani is, of course, still with us. Hemang, just a quick word on how you would look at this entire MSCI Adani news flow. Because stocks were starting to get a bit of a reprieve, right? After the lows that they made, I think, last Friday, stocks in many cases are up quite substantially. Your sense?
So, Prashant, I think, first of all, there are 8 companies which are part of this MSCI, general index, and 3 companies where there can be a cut of weight anywhere from 20% to 50%, which could result into outflows of about $200 million for the Adani total gas. And for Adani Enterprise, the outflow could be about $15 million. So clearly, this is going to be a bit negative for some of the Adani group companies. And we have to see whatever is the cut in the weight for the Adani group, whether there is a corresponding increase in the weight of some of the other companies in India, or they choose to kind of increase the weight for some of the other companies. So that is something that remains to be seen. But clearly, there is going to be some negative impact because of the sell flows because of this development.
Okay, all right. Well, the other stocks that I wanted to discuss with you, Hemang, was the auto stocks. Now, this time around, the numbers have been on the weaker side, especially for the auto companies that have a rural exposure, whether it's Hero MotoCorp, Escorts. But on the flip side, the guys who have an electric vehicle exposure have done pretty well, even in the auto ancillary space. So it's a very diverse performance. From this entire lot, anything that you would pick from a long-term standpoint?
So, Sonia, I think there is a bit of a divergence, as you said rightly. But within the pack, we've seen many companies delivering good, strong set of numbers. So, something like a Samvardhan Motherson, which came out with numbers, I think the numbers are good, and we are looking at a very significant revival in the auto ancillary space. So, that is something that we've been liking. And apart from that, I think we could also look at something like Endurance and the Maruti, which also has slightly corrected in the past few days, because there again the overall growth visibility looks pretty strong. So overall auto sector remains strong. It is up 6%, by the way, the biggest gainer across all the sectors, and certain pockets which are doing well. That is where we would have our preference.
All right. Thanks a lot, Hemang, for stopping by and filling us in with your analysis on a whole host of stocks. Wishing you a good day ahead. Good time to get in some F&O strategies. Manoj Muralidharan, VP Derivatives at Relicare, joins us to fill us in with exactly that. Morning, Manoj. What do you have for us?
Good morning, Nigel. Nigel, today being expiry, we'll first talk about the intraday cues. Now, even yesterday, if you see, the breadth in the Nifty was almost positive. But then if you look at hardly 3 to 4 stocks had long bit up. So we believe it is more of short covering bounds that is there in the market and not really a long bit up. So 17,930 to 950 on the futures becomes a good level to go short, or you buy a 17,900 intraday put option of today's expiry, and we're expecting the Nifty to drag down to almost 17,780 to 800, and we're expecting the spot expiry can be closer to 17,800 to 830. Now, if you see the FIs, and they are still maintaining a short position of almost 80 to 81%, and all this 400 odd points of bounce that we have seen in the market has not really catered to a 2 to 4% difference in the short positioning. So stock specific, yes, we believe stocks like Reliance can be a good buy. 2340 is a good level to go long with a stop loss of 2310, and we expect the stock to go to almost 2390 as a short-term target.
And okay, all right. That's on Reliance. Any other stocks that you're looking at?
Stock specific, Sonia, we could be a bit negative today. So, we expect even the bank Nifty to time down to almost from the levels of, let's say, 42,000 odd. We believe the bank Nifty might have a first support at 500, and then there is a 400 more points at the downside, so 41,100. So, the major banking stocks can be a sell and rise, but then if it is the index, it's better to buy a 41,600 put option for intraday with expecting at least a 300 rupees target on that.
Thanks, Manoj. Wishing you a good session ahead. Appreciate your thoughts. Well, let's move on then. And I think today it's going to be quite crucial because there's a lot of news flow on the Adani group, and the markets will make up its mind whether or not the Adani issue is past it and whether it's prepared to move on. I think we'll get the answer to that today. If the markets can hold on or move higher, then that will give you some evidence that maybe the market is ready to put the group worries behind them and move on. For the time being, let's focus on a couple of Adani Group stocks on the cement pack. We have Naveen Sahadev, director at Nuvuma Institutional Equities, who joins us to discuss about all the news flow on the cement space. Hi, Naveen. Good morning. Good to speak to you, Naveen. And we've got, three pockets that we want to talk about. One is on the ACC Ambuja Group. Then, in fact, we want to talk about the GST, as well as, finally, your picks from the sector. So let's start off first about the group call yesterday. Ambuja's con call, I managed to get a sneak peek into it as well. And the management, they clarified on a whole host of issues. The question is, are you convinced with their answers? And what will your view be on the stock post this big correction that we've seen?
So operationally, both ACC and Ambuja, I think, have given a remarkable performance. In just a span of a quarter, they have managed to reduce the freight cost significantly. All the things which initially we were like, or the street was ascribing to once these two companies come under the fold of Adani, be it the volume momentum, be it the cost rationalization across. It's not just fuel or logistics. In fact, on the earnings call, the management said that there's no stopping here. They are looking to further intensify the efficiency enhancement measures. So it definitely did throw up a positive surprise both at ACC and Ambuja. I think operationally, they really have a lot of headroom to improvise further. And in fact, they also reiterated that the plans to double capacity in 5 years remains very much. In fact, details of that will be shared next earnings call.
So what is your view on the stock now? With a long-term horizon, do you think the stocks ACC and Ambuja become good buys at this price? Is the risk-reward favorable?
So definitely there is value in these stocks if you were to take a slightly longish view, because consistent volume growth and a combination of huge cost rationalization is not something that you are having many options at least in the cement space as such. So definitely, having seen the kind of correction we already have, definitely there is value on the stock, despite assuming lower valuation multiples. Also, I'm sure there is value to be seen from a 1 year or a medium to long term perspective.
Okay, but Naveen, let's turn the question around. Everyone was talking about re-rating of both these two stocks. But now, since the group is in, a bit of a tizzy, would it be better to go with the big boy out there, UltraTech Cement, large capacity, volumes will come out there, cost saving for the industry as well, and the market leader? Or what's your choice between the toss-up between both these two?
So let's put it this way. If Adani as a group continues to focus on volume maximization, as in huge capacity growth, the kind they are talking, there are other large companies, be it Dalmia or other companies like Shree, who are also focusing on giving huge capacity targets 3 year, be it 3 years, 5 years. So in that kind of environment, overall cement space per se, the demand supply is not going to be very balanced. That's point number one. And as we speak, the industry is really feeling the heat of weak cement prices. As such, it's even safe to say that the industry does not have any pricing power demonstrated in the last several quarters. So in that light, I don't see UltraTech to be a really a great option. Of course, it's a great company, but from the overall sector perspective, I still think there is caution to be advised. Purely from the weak pricing power. Demand, everybody is convinced, cost is going down, but commodity business, you need pricing power. There's no pricing power.
Okay, there is a possibility that the GST rate on cement could be reviewed and, I mean, it could be cut from 28% to 18%. At least that is what the expectation is. If it comes through, then what would the, the effect be?
See, of course, we have heard this in the past as well, right? That government is looking to rationalize the GST on cement, and there are numbers floating around from 28, it could go to 18% or so. Sentimentally positive for sure. Of course, you have to pass it on, but it's definitely sentimentally positive because even if, like, there is a marginal sort of an increase also on the realization in the transition phase, it could still be very positive for the overall sector. So definitely sentimentally positive for the sector if it goes down.
Okay, all right. We will leave it at that. Thanks a lot for joining in and giving us a quick take on the cement space. So that's what's happening within cement. But let's get back to the markets now, because in pre-opening, the rates have settled absolutely flat. A couple of stocks, actually, Oberoi Realty is reacting very well to its numbers. So that's up almost about 6% in pre-opening. L&T is up almost about 1% so looking pretty good there. On the downside, you have Escorts that is reacting to its weak numbers. And Adani Group stocks, Adani Ports is down about 2%. A lot of the pharma names, Cipla, Apollo Hospital, Divi's, Sun Pharma, Dr. Reddy, all in the red this morning. So that's perhaps a sector on the back foot. Let's get some 9-10 calls going as well. Would be interesting to see what's happening with Paytm and Zomato. Both those stocks had a dream run yesterday and looks like there's some more follow-on buying today. Sudarshan, what would the big call be at 9-10?
Stay long in the Nifty, buy Apollo Hospitals with a stop under 4,300.
And Mitesh, how about you?
I'll go with a buy on IGL. Keep a stop at 430. Look for targets of 450.
All right. Well, the Adani Group stocks are definitely in focus ahead of the MSCI review. Vivek is here to give us more details on that in case you missed it. Vivek, over to you.
Well, that's right. So the MSCI statement has come in today morning. What they're saying is that as part of the review that is expected later today, they will be looking once again at how the Adani Group stocks that are part of the MSCI Global Standard Index will be treated. So now, as per the initial estimates that we're getting from our analysts, the first thing to note is all of the Adani Group stocks, barring Adani Wilmar as well as NDTV, are part of the MSCI Global Standard Index. And the three stocks, that could have the highest impact, given the fact that they have the highest weighting in the index, is Adani Enterprises, Adani Total Gas, and Adani Transmission, expecting a weightage reduction rather than a deletion of the stocks from the MSCI Standard Index. And also, an unlisted entity from the Adani Group. But yesterday, in its post-earnings conference call, Total Energy's chairman actually has said that they have put on hold the $4 billion green hydrogen investment with the Adani Group that they have earlier announced in June 2022. So some more negative news are coming in. However, they have said right now it is on hold. After the audit is completed, they will look at, they will review the investment decision once again. He've also gone ahead and defended their investments as far as the other Adani Group stocks where they already have existing investments and are partners with the Adani Group.
All right, Vivek, thanks very much for that. So keep an eye on those names as we begin trading. Cummins is the other one we want to highlight. Once again, Maheshta is here with more. Maheshta.
Hi, Prashant. Well, Cummins had excellent set of numbers coming in yesterday post-market. In fact, the company has reported record quarterly performance, which is driven by strong domestic as well as their export revenues. The revenues came in at 2,180 crores, which is 12% above the estimates, as well as the margins, which are above 330 basis points above the estimates. The export revenues have jumped by 23%, while the domestic sales are higher by 27% on a year-on-year basis for Q3. The company has also said that the demand momentum which was witnessed in the earlier quarters has continued in this quarter as well. In terms of outlook as well, the company is quite optimistic. So we also have the con call in a few minutes. So back to you.
All right, thanks a lot for that. Well, we're just heading into market opening. By the way, since we're talking about good set of numbers, Gujarat Pipavav was also a very good set of numbers. The EBITDA went up almost 65%. And in pre-opening, that stock is looking good. So just keep an eye out on that as well. We're heading into the market opening and looks like it's going to be a very, very flat showing this morning. Remember, there are mixed cues. I mean, for the last couple of days, the index has been moving higher. But this morning, global cues are not that great. The Dow is down about 200 points overnight. So give and take everything, the market is pivoting around this 17,800, 17,850 mark. That's the first tick on the index, absolutely flat for the Nifty. 17,850 is where we're at. The Bank Nifty is also very, very quiet. And the first tick on the mid-cap index is also quite flat. What's looking up is L&T. L&T is your big mover, up about 0.6%. Then you have Hindalco and Tata Steel that are making an attempt to come back, up about 1% there. Asian Paints, Coal India, Power Grid and Axis Bank are a couple of other stocks that are trending on the green line right now. On the downside, the Adani Group stocks are all taking a big knock this morning once again. Adani Enterprises down 10%, Adani Ports down 5.5%. And ahead of the MSCI review, the rest of the Adani Group stocks are also a bit tentative. ITC is coming in for a bit of profit taking. Maruti Suzuki, SBI, Apollo Hospitals and Grasim are a couple of other stocks that are trending in the red right now. Now the market is actually dragging its feet. So the Nifty is down about 50 odd points. Not a good opening for the bulls. The Sensex is down about 80 odd points. And all your Adani Group stocks, the power, transmission, ports, enterprises, Ambuja Cement, all down about 5 to 10 odd percent. Adani Green as well, not looking good at all. Banks are also taking a bit of a knock right now. So 70 points lower on the Bank Nifty, led by Bank of Baroda, SBI, PNB. So all the PSU banks are, facing a bit of heat right now. Even private sector like ICICI Bank not doing too well. So it's a start on the back foot. Slightly under pressure now for the market.
Well, that's right, Sonia. And it's going to be a buy on dips. That thesis is going to be tested today because 17,750, that level should hold out. At least that's what the positioning is. And given that we are into a weekly expiry day, things are going to get volatile. Let's talk about a few stocks that are moving around. Then you have a couple of good earnings reactions. Trent is high with a gain of around 3.5%. You have NCC as well that's doing quite well with a gain of closer around 3%. Also joining in there is ITD Cementation. Well, that one as well is gaining in today's trading session. Cummins, well, we just had Vaista who told us that those numbers look strong. We'll wait by for the con call details as well. That's flying away. That's up 6.5% as we speak. Gujarat Pipavav, well, we already had Sonia speak about that. Equitas SFB as well, that one's doing quite well. On the flip side, some negative earnings reactions as well. You have Piramal Pharma. Well, the management had guided for a strong showing in the second half of the year. That's not yet showed up. So the con call is going to be very, very important because the stock is less than half from its listing price. That's taken a hard knock this morning. It's under pressure. And a couple of other notable names, you have ACC and Ambuja, both of them are under pressure. That's more a group-related issue. The con call yesterday was par for the course.
All right. Just a few other names. We've got about a 50-odd point cut on the Nifty now. We are at 17,819. So it's a lower start as expected. The new age stocks all did very well yesterday, and I think there is some continuity in terms of action. Paytm is up 2.5%, and it's coming up on the back of very strong volumes. Nykaa is up 4%. Nykaa and Policy Bazaar saw rub-off impact from Paytm and Zomato yesterday, and they're doing well. Nykaa is up 4% or so, but those are the only two I can spot so far. Adani Wilmar is up 1.75%. It's one of the few Adani names this morning which are in the green, but this one is. Trent is up 3%, 1,274, 1,275. Again, large volumes. Sonia mentioned Oberoi Realty, 1.5% higher, 852. NCC is starting about 3% in the green, and that is a decent kind of start for that one. Apart from the Adani stocks, largely which are under pressure today, I'm going to try and spot what else is down and out. Not very much. Piramal Enterprises is down about 1.25%. We highlighted Piramal Pharma earlier, but Enterprises is down as well. And there is Escorts, which is selling off. Of course, we highlighted the results, 2% lower. They're weak. And there is REC, which is down about 2% or so as well. So, it's a tentative kind of start. Market breadth is still positive. You've got about 900 stocks which are higher and about 800 stocks which are lower. So not that much of a difference. And just 4 minutes into this market open. Sanjay Mukim is our market master. He's strategist and head of India Equity Research at JP Morgan, India. Sanjay, great to have you with us here. Thank you very much. How has, Sanjay, your view evolved on what we've seen over the last 2 weeks or so? A little less than 2 weeks. There has been a fair bit of turmoil, dislocation in markets because of, troubles at a large business conglomerate. How are you viewing it, and what's the feedback from your global teams as well?
Well, good morning. Great to be on. Our view getting into the year, even in our year ahead notes, Nigel, was to suggest that India will probably need to go through another year of consolidation in 2023. Multiples for the index, multiples for a large set of stocks are still higher than average, still higher than where they were in December 2019. And as the growth momentum of the economy normalizes post the reopening bump that we've seen in 2022, you will need to start to consolidate into more average multiples. And this is not even rocket science, Nigel, because India outperformed EM last year handsomely by doing virtually nothing. The index delivered 4.8% returns in rupee terms and was negative in dollars. Yet we outperformed because North Asia was doing poorly. And we are reversing that trade now. As China reopens and places like Korea and Taiwan start to look better incrementally, then investor focus shifts to North Asia, and which becomes detrimental for India's relative performance. So 2 or 3 things. One, relatively, other people doing better. Absolute-wise, the Indian growth valuation cycle starting to normalize. We did argue that you will not see too many returns out of the index in India for 2023. And whatever's happened in the last few weeks kind of just supports that point of view, that there is additional volatility, there is additional beta in the market. And our recommendation to investors obviously has to be to move portfolios to large cap quality stocks in India and avoid the mid cap, slightly less illiquid names.
Okay, all right. So move portfolios to larger quality stocks. By the way, Sanjay, good morning. That was Prashant, and this is Sonia. So you're saying that you're a bit cautious on the market now, and it's better to perhaps stick with quality. But do you believe that the worst of the rate tightening cycle is now behind us, both globally and locally? And if that is the case, do you think that the market could be pricing that in and perhaps see an up move, even if India underperforms compared to its peers?
Good morning, Sonia. I think there are 2 sort of responses to that. The first is yes, that we do not really expect as a house any much more material rate increases, right? Maybe the Fed and maybe the RBI could potentially surprise you a little bit here and there, but we are at the peak of the tightening cycle. And this is, of course, contingent on the fact and the consensus view that inflation everywhere will continue to fall, as mathematics would suggest it will. The debate to have is whether you will actually see any rate cuts this year, whether it is at the Fed or at the RBI. And at least in the US, rate cuts seem to be priced into markets. So people are assuming that once the Fed gets to that 5.25 levels, it immediately starts cutting and ends the year somewhere in the mid 4%. And the debate there is, will that really happen? Will the Fed go to 5.25 and pause through the year, or will they immediately launch a cutting cycle? And that's where we are a little bit nervous, because we do not really see reasons for big rate cuts this year. Yes, the pause may happen, but the pivot is still debatable.
Okay.
Well, hi Sanjay. I recall, the last time when we chatted, you were talking about the China reopening theme. It has more legs. Some part of that has played out, right? Chinese markets are not as cheap now to the Indian market. So could we start finding favor at some point of time, given the recent underperformance of 3-4 months or do you think the outperformance prior to that was enough for us to consolidate for a longer duration?
Well, technically, look, we've just about given up our outperformance over the S&P 500 that we earned last year. And through the last 14-15 months, India is now on track with S&P in dollar terms. But we still retain significant outperformance over the EM index. So it is possible, just like I said, a very minor technical point, it is possible that India treads water for a little bit longer. The way I would think about it is that while the market in China may have gone up now, data in China will probably remain strong for the next few months. I mean, you will get, strong GDP prints, strong retail sales. All the reopening related positivity that we've seen in India through 21-22 will now possibly play out in China. So it might be very difficult, I think, for you to go out and say, hey, China's done, into the strength of data that's still to come.
Okay, so what does this mean in terms of how to allocate your portfolio for the full year? If you think that India is going to perhaps underperform compared to peers like China, and then again, there is this whole rural slowdown that's also taking place in the Indian markets. We are speaking to a lot of companies, and it doesn't look like there's a massive recovery, at least on the consumption side. How do you structure your portfolio? What are the sectors that you keep? What are the sectors that you avoid?
Well, I'll make 2 or 3 comments there, Sonia. One, our filtering criteria and stock selection criteria is to look for earnings surprises. And that has worked well for quite a few years. We try and buy companies where we think earnings will beat estimates and sell companies where earnings will miss estimates. And starting this year, we are kind of struggling to find a broad basket of companies where we think earnings might exceed forecasts, right? Because expectations have gone up a lot through last year because markets did well. Analyst forecasts are a bit too high to my mind. We are therefore this year filtering for stocks which will not miss estimates, where we don't see disappointments. And in that sort of a screening mechanism, banks still kind of rank very highly. Okay, we're seeing very strong on the ground momentum. Now, you could argue that the upgrades for banks are also largely done because people have understood the phenomena of higher NIMs, lower credit costs, higher loan growth, and so on. But at least we don't see risks that you will see significant earnings disappointments. And additionally, financials and banks remain the only sector in India which kind of makes sense on a DCF. So if you were to model the top 200, 300 stocks, it's largely the financials which make sense on a value screen as well. So both earnings and value point you in terms of financials still. The risk to banks, I think, this year would be macro. So should you start to see GDP growth disappoint, should you start to see some wage weakness or job losses, that could rub off negatively on banks in India. But for now, I think banks continue to make sense. And at least especially the large cap deposit funded banks are stuff that we favor. We don't like the high-end consumer space. The consumer discretionary, this is something I have been arguing for a few quarters now. It's playing out. Demand is coming out weaker than expected. Commentary is deteriorating for companies where multiples remain very high. So our big long short is to stay long financials and short the consumer discretionary. As defensives, we still have staples. We like real estate. We upgraded insurance before the budget. Now we'll have to see how that plays out.
No, even on banks, and you're exactly right. What matters, of course, is earnings. The degree of earnings surprises or disappointments. Even in banks, not seeing too many upgrades. I mean, except SBI, which has seen some 3-4% upgrade since over the last month or so. Not very much by way of upgrades. IT is one area where your analysts had a very strong view. How has that view evolved now, and where are stocks after the recovery they've seen?
Well, the trouble with IT is twofold, right? I see the argument from a lot of clients who want to rotate into a sector that has underperformed last year and which are perceived as great corporate governance, good cash flow generating businesses. The trouble is that we're still staring into a down cycle. And, as the US economy slows, as developed country economies slow, the top line outcomes for many of these IT companies are likely to deteriorate. And this is, I think, very well modeled, very well appreciated by analysts and investors. The debate is around the margin outlook for next year, because most estimates imply an expansion of margins in FY24. And our nervousness is around the fact of negative operating leverage. When your top line is slowing, will companies really be able to deliver on the expected margin expansion through next year? And if they don't, then you will see earnings misses, earnings downgrades, and so on. And lastly, some of the large cap IT names are still trading above average and still trading above December 19 multiples. So you don't really have comfort entirely on valuations, not on the EPS as well. But I see a lot of people trying to diversify portfolios because they've owned banks for a long time. And IT makes a natural candidate for a lot of my investors.
All right, we will let you go on that note. Thanks a lot for stopping by and speaking to us. There are lots of stocks to discuss, but that was JP Morgan India talking about how they're a bit cautious overall on the markets. By the way, Cummins is the stock of the moment, 8% higher and big volume jump up on Cummins. In fact, it's had a good month so far. And of course, the numbers were also very good. Strong performance for the domestic segment, quarter-on-quarter improvement in margins. So that helped the up move in the stock as well. Couple of other stocks, Oberoi Realty looking pretty good as far as the numbers are concerned. But Cholamandalam Finance is the other stock that we're looking at. If you remember, a couple of days ago, the company reported a very robust third quarter earnings. It's clocked in its highest ever quarterly profit, and the sequential loan growth has come in at a 26-quarter high. Arul Selvan D, the President and CFO of Chola Finance, joins us now on the show. Arul Selvan, thanks a lot for joining in. Is this a performance that is sustainable, the kind of loan growth that you did in the quarter gone by? And now that things are picking up, tell us about the segments where you see a big up move coming from, and what is the kind of loan growth that you can generate in FY24?
Yeah, thank you for the call and for this interview. Yeah, we are looking at a good growth in the current, the final quarter, which is the JFM quarter now, as well as in FY24. As you know, our primary focus is on vehicle finance. We have the second loan against property and HL. All these are clocking good growth. We have also introduced 3 new products. Again, they are showing good traction, especially in the CSL and SME segment. So we see good demand pickup happening across the board. While we have not focused or we are keeping still a little low profile on the heavy commercial vehicle, which is which is more addressed by the banks because of the fleet operators being there. The rest of the segments in the vehicle finance, loan against property, HL, as well as the consumer and small enterprise business, which you have started recently in the SME business, will all show good traction as we move into the financial year. The new businesses, we will take it with a little bit of a caution as we go through certain life cycles in these businesses. So the scale up will be little, slow, but because the base is low, the scale up looks very high.
So what did you say about the heavy commercial vehicles? You said that that is looked after by the bank. So are you seeing that pocket slow down for you? Is that the right way to look at it?
We have always been a little slow in the heavy commercial because heavy commercial vehicle is more, dominated by fleet operators. And the fleet operators are mostly serviced by banks because their yield expectations are very fine and they buy it in bulk. So the ticket sizes attract the banks as well as they can afford to provide them the yield they are looking for. We do heavy commercials only in what we call as the secondary, fleet operators or the individual transport operators, the small road transport operator types, where the owners own less than 10 vehicle types at any point in time. So that segment is still not picking up. They are more focused on buying used vehicles. So that's where the heavies we are not at scaling up significantly, but it will move progressively into it. But across all segments, including heavies, our market share has grown.
Okay, all right. Good morning, Mr. Arul Selvan, and congratulations, sir, on a very, very good showing. I think there was a consensus beat is what we saw, so good on that. But what's the way ahead? If you could tell us, putting all the factors that you put on board, what is the AUM growth you're factoring in? Maybe what you end this year with, as well as the next year. The other important factor is NIMs. How are they likely to shape up in a rising cost scenario? Can you hold on to the numbers that you have delivered? Go ahead.
Yeah, see, as you would have seen, we have grown the AUM YTD December at to the extent of around 31%. I expect the Q4 should, keep it at that level, around that level. So 30% plus is what we will close the year with on the AUM front. The FY24, we because the base is lower. As you know, the last year, FY22 was actually a 9-month because the first quarter was not a great performance because of COVID-2. So that's where the 31% growth seems to be very high. But as we move into next year, the growth year on year, because it will be a 12-month versus a 12-month comparison. So you will have, my expectation is it should be in the range of around 22 to 25% on the AUM growth next year. Coming to the NIMs, NIM will have a slight bit of impact because of the rising cost of funds, but we are addressing it by increasing the yields wherever it is possible, especially in the floating rate books, which is the loan against property and the HL, where we have done the yield adjustments for entire book. And on the fixed rate book, which is the vehicle finance book, we are doing it on the marginal yield on the new loans that are booked. So to that extent, on the existing book of vehicle finance, there could be some impact of on the NIM. But I think that would be more than sufficiently compensated by reduction in net credit losses, because now the borrower's earning potential has substantially stabilized, and so they are, returning back the monies, and overdue collections have been quite robust, and our overdues or delinquencies have been continuously coming down, and I'm sure we will be able to.
What is the number, sir, you could give us? What is the number you could give us in terms of NIMs?
On the NIM, we should be in the we should be at around 7% on the averages. It's
7%.
Okay, all right. 7% on an average is what you're looking at. And you said your delinquencies have come down in a big way. Can you quantify that for us? What has it been in the quarter gone by? Just to get an understanding of how much things have improved as far as, the asset quality is concerned as well.
See, the 90 plus, what we term as stage 3 under the Indices, is now at the end of December is at 3.5%, which was at 3.84 in September 2022, and at above 4% in the previous year. So this has been continuously coming down. If you go back and see the Q1 of last year, immediately after COVID-2, it was as high as 6.5%. So from there, it had been progressively coming down, and we have kept, brought it down to 3.5. Not only stage 3, which is 90 plus, even stage 2, which is anything above 30 plus, has come down substantially. And these are, given us a good traction with regard to keeping our NCLs in control, especially in Q3. If you see, the NCLs have come down. We had a certain amount of higher losses in Q1 and Q2 because we had to repossess and sell assets. Comparatively, Q3 is a good quarter, and we expect it to improve in Q4 as we move it to close the year.
Okay. I understand that Credit B, which is your app, has been banned by the Ministry of Telecom, and this app had about 10% of your new business coming in for you. Has it hit your business in a way after the app was banned?
No, it is not 10% of all our new businesses. It is 10% of the CSEL business, which by itself is, less than 3% of the total business. So it is one of the new businesses. We had one element of one of the fintech partnership. So if you look at the CSEL business, it has got two segments, which is the partnership business, and then we also have the traditional business where we do sourcing and collection on our own. The proportion between these two are also like 1:2. That is that fintech related business is 1%, and one time, and the traditional business does twice the turnover of that. And CSEL business by itself is around 3.5% of the overall AUM. So yes, there is a thing, but we are, people are taking up with
Mr. Arun Selvan, what exactly is the CSEL business, if you could explain?
That's the consumer and small enterprise business. This is a new business we started recently. Yeah.
Okay, so 10% of the CSEL businesses contribute by the app, which is a very small
Not
portion.
even 10% of CSEL business, madam. Yes. It is 1/3, 10% of 1/3 of CSEL business. So this is actually a very minuscule part of the total business. But yes, it's a good relationship, and we would like to bring it back. Okay. Everybody's working towards getting that.
All right, very quickly, sir, the new loans part of the business, that's been scaling very, very well. It's unlike actually the group strategy in the past. Where do you see this move as a percentage of your total book? Point number one. And also, how confident are you on the quality of this new business? No worries are there, right?
No, see, new businesses right now is around 7% of the total AUM as we closed December. In this actually SME business we have been already doing, but we have been doing it more with regard to our Murugappa Group related vendors and customers. So there would been a little bit more comfort. Now we are spreading out to do that with other vendors, other borrowers. So to that extent, having experienced it, we are now experimenting it with other companies. We will, right now they are doing extremely well, but like initially when we are doing smaller volumes, NCLs will be absolutely negligible. Today there is absolutely no NCL on CSEL business and the SBPL business as well as the SME business. But as we grow, there will be some amount of NCL we will certainly see in these businesses, but the yields on these businesses are very high. So we are sure that these businesses will remain and will be ROA accretive to the overall company, and that's where we are moving in to grow these businesses.
Okay, all right. We appreciate speaking with you. Thank you so much, Mr. Selvan, for speaking to CNBC TV18, and all the best. It's been a very good quarter for you, and you're guiding for more than 30% AUM growth. I'm sure that's going to make your shareholders very proud. Thanks a lot for joining in.
Thank you. Thank you.
Okay, that's one of the strongest stocks in the NBFC space, and very strong guidance coming in from the company as well. But let's move on. Here's some exclusive opinion. Veteran banker Uday Kotak says that Indian corporates need to borrow more from Indian institutions and not from foreign banks. Speaking at the CNBC TV18's IBLA jury event, he said the risks of global borrowing is that foreign lenders may not understand the Indian dynamics as good as domestic lenders. Listen in.
I think and I see a lot of corporates here, they should be borrowing more from Indian financial institutions. They're borrowing too much from outside. I'm sure my banking colleagues will agree with us.
Mr. Khara, you want to come in on that as well?
No, I think market is probably guiding them to borrow more from the Indian market. No, global markets.
And I believe that, and I'm not going into any specifics. I think this is a time for Indian financial sector to build its capacity, both in terms of underwriting skills as well as scale. And I do not believe global financiers necessarily have better underwriting skills, but India has to hone it, and its own financial sector should be able to do thorough diligence and get its underwriting right. If we do that, and we need to build a whole host of capacities in India so that corporates feel that the first port of call is to borrow from India. And the risks of global borrowing is that a person sitting in New York, London, Zurich, Hong Kong, Beijing, wherever, may not understand the Indian dynamics as well and is very much focused and impacted by media reports globally. And decisions can be taken more superficially without going necessarily into the facts of the case.
All right, let's slip into a short break. On the other side, we will connect with Sunil Bora, who's the Group CFO of Uno Minda. They reported a very strong set of numbers as well. More on that in a bit. Also, we'll connect with Arun Jain, who is the management of Intellect Design Arena, to discuss their Q3 earnings. Stay tuned.